Good day, everyone. Garrett Moore here, More Financial Management. Whole lot going on in the market, so I wanted to share with you a couple of thoughts and observations about what's going on and what you might ultimately do about it. Let's jump right in. So what is going on? Well, I think the majority of the market turmoil going on right now is simply caused by the Federal Reserve and them raising rates. So this is by design, right? So it's part of the Federal Reserve's job to effectively take away the punch bowl from the party before things get too crazy. We saw a lot going on in the economy that was indicative of it overheating. We saw inflation, of course, that's the main one. We had an incredibly tight job market. We had housing that was getting out of control. There was a lot of froth in the investment markets. So by them raising rates, what they're intentionally trying to do is put the brakes on things before they get really out of control and we wind up in a bubble or an inflationary spiral of some sort. Okay. The other part of this is that the pendulum is simply swinging towards fear at this point, I think, right? So as rational as the markets can be at times, they're always in a constant state of flux between greed and between fear. We are firmly on the fear end of the spectrum at this point, and I'll talk about that more in a minute. Cullen Roche, love this guy, love this quote. Something to think about right now. The stock market is the only market where things go on sale and all the customers run out of the store. We all need to think about this. When it comes to absolutely anything else in your life that you're thinking about buying, you go back to the store a week later and it's 20% off. What are you going to do? You're probably going to buy it, right? You might even buy two pair. But when it comes to our investments, we think about them in the exact opposite way. And we need to be conscientious of that and work towards reversing that. Brendan Fraser, I love this. Selling out when the market is plummeting isn't irrational. It provides the person a sense of relief, a perfectly rational desire. It's just phenomenally expensive. Right? So what's he talking about? He's talking about panic selling. Market gets crazy, market goes down. Oh my gosh, stop the pain. Sell me. I'm done. I'm out. Right? But what happened to the person that did this in 2008? What happened to the person that did it in 2018? What happened to the person that did it in 2020? Right? It all wound up being a very costly mistake because the market continued to rise to all-time highs as it's done 100% of the time. Okay? Nick Majuli, the author of Just Keep Buying, sums it up perfectly. You may be right now, but you'll be wrong later. All right, a couple of things to keep in mind here. One is that this is normal. This super fancy, confusing chart can be summarized into two things. One is that the average annual decline of the U.S. stock market in any given year is 16%. All right, so at some point during the year, the market is likely going to be down 16%. Sometimes more, sometimes less. 16 is the average. Okay, we're at around 20% at this point in time. But the point is that this happens all the time. But each and every time that it happens, it feels momentous. It feels like the end of the world. It feels like this is the big one. It feels like this time is different, right? Okay. The next point, of course, is that the average annual return, despite those declines, is 10% per year. You gotta stay invested to earn that. You have to deal with the 16% downs to receive the 10% ups. All right, the Fear and Greed Index. This is an index that looks at a number of metrics in the financial markets to figure out how investors are feeling. Investor sentiment, it's called. All right, so on a scale of 0 to 100, with 0 being extreme fear, we are currently at a 7, right? That's wild. That's as bad as it's been in a very long time, and it's significant, right? Okay, so let's talk about what to do with that. All right, one of my favorite quotes of all time, Warren Buffett: be fearful when others are greedy, and greedy when others are fearful. Okay, think about that for a second. And two key points. Warren puts his money where his mouth is. All right, you might recall in a video that I did from 2020 during the height of the coronavirus pandemic that Warren Buffett was buying stocks in airline companies. Okay, you don't have to be a financial expert to take a guess at what airline company stock was doing when travel was effectively non-existent. Right, airline stocks got hammered. All right, to say that people were fearful when it came to those companies in that industry would be an understatement. Buffett came in and he bought those shares at that point. Okay, we need to emulate the people that have been successful in investing if we're going to be successful as well. Another one of my favorite examples, Sir John Templeton went on to found Franklin Templeton Investments, one of the best investors of all time. He actually started his investing career by going out and getting a loan to buy the cheapest stocks in existence as World War II was starting. Okay, you want to talk about fearful? Let's talk about a war that was literally engulfing the world. One of the best investors of all time went out, borrowed money so that he could invest it. All right? Keep that in mind, please. Another key point here that I want you to keep in mind: the market will recover before you think it will. All right? What am I talking about here? Let's visualize. Let's go back in time. Visualize March of 2009. Okay? Of course, this is the global financial crisis. Okay, in the U.S., we're talking about house prices collapsing. We're talking about widespread defaults on mortgages. We're talking about people questioning the stability of our entire banking system. The stock market was absolutely collapsing. Okay, to say that things were dire, again, would be an understatement. Okay, now let me ask you this: what do you think happened in March of 2009? That was actually the bottom of the stock market. Okay, so despite everything that was going on in the world, that was the bottom of the stock market. From there on out, the market recovered from the global financial crisis. Okay, the market sniffed out the recovery before anybody else did. The market is a leading indicator. Okay, this happened again in April of 2020. Let's go back to then. What was going on in the world then? Right, the world was literally engulfed by a deadly virus that we knew very little about. The global economy was effectively shut down. Right? Trade came to a screeching halt because nobody was working. Everybody was holed up in their homes. Okay? Now take another guess. What do you think happened in April of 2020? That was the bottom of the U.S. stock market. From there on out, the market recovered from the coronavirus declines. Okay? I'm willing to wager that the market is going to do the same this time around. One point, the market will recover before you think it will. Second point, when it comes to anybody that's thinking, hey, I'm going to sell out of the market and I'll get back in later, you probably won't, because there isn't going to be an all clear sign. It just doesn't happen. It doesn't work that way. It didn't in 2009, it didn't in 2020, and I don't think it'll happen that way this time around either. Okay? This is an interesting little tidbit. Stock market visual comparison. Over on the left, we have the U.S. stock market typical chart. All right. We live in the information age, right? You can all pull up an app on your smartphones and get instant access to your accounts, and you could watch them second by second if you wanted to. It's going to look and feel a lot like the chart on the left, right? That's your right. You're welcome to do it. But what happens if we just take those dips out, right? How do you feel after looking at the chart on the right versus the chart on the left? You feel a little calmer. You feel some peace. You feel some anxiety just leaving you, right? So obvious point, where do both of those charts wind up? Same exact place, right? So food for thought. In times like these, it can be helpful to just zoom out, not focus on this so much. It's going to pan out the same way either way. Yeah. All right, so what should I be doing here? Jack Bogle, one of my favorite guys in the whole world, God rest his soul, founder of Vanguard, one of the best investors of all time, quoted as saying, "Don't do something, just stand there." Right? The polar opposite of what we're typically taught in life. But when it comes to investing, we need to be doing the exact opposite, right? Because the way we're hardwired, anything you do during times of greed or in times of fear, anything you do emotionally is probably going to wind up being phenomenally expensive. Okay? Like I said, just zoom out, right? So what does the market tend to look like over the long term? Call it 5 years. Versus what does it look like over a period of 5 days? Wonderful chart by Carl Richards at the Behavior Gap. Love that guy. Such a good perspective, such a good lesson, especially in times like these. All right, moving on to the more technical aspect, another thing that you can be doing is rebalancing your portfolio. Okay, this is something that I take care of for you here, but when it comes to your accounts, it's your 401k, stuff like that, you can't forget to do that either, okay? So let's talk about a hypothetical portfolio. Let's say that we go all the way back to 2012. You start out with half stocks, half bonds, okay? Over time, your stocks are probably going to do better. That's that orange line. And of course, your bonds are going to be far more stable. But fast forward to today, if you haven't done anything, it's going to be out of whack compared to what you started with. And you need to rebalance. You sell what's done well. You buy into what hasn't. You stay on track. You stay on target. It's a great way to manage risk, and it's a great way to buy low and sell high. All right, another good one is to view market corrections as opportunities. Okay, this applies to retirees as we rebalance your accounts, but it really applies to those of you that are still saving, still accumulating. Okay, effectively, you get to buy more shares at a lower price. Okay. A quote by the Capital Group: every S&P 500 decline of 15% or more from 1929 through 2020 has been followed by a recovery. The average return in the first year after each of these declines was 55%. Okay? Therein lies the danger of trying to time this. The danger of trying to get out of the market and get back in. If you miss out on that, which you likely will, because like I said, there will be no all clear sign. It's going to happen before you know it. You're going to miss out on those gains and drastically alter your investing experience. All right, so recapping, don't do something, just stand there. Zoom out, rebalance to manage risk and to buy low and sell high. View market declines as opportunities. And of course, if you're still nervous, still anxious, let's just talk, and let's talk specifically about how this affects you personally. But I hope that helps. I appreciate you all. Don't hesitate to reach out. Have a wonderful day. Talk to you soon. Bye-bye.